Okay, first and foremost, thank you all for being here and allowing us to use some of your time to talk about some of the changes that we have coming up for the upcoming open enrollment year. My name is Hiron Stiell. I'm a Benefits Specialist here at the university, and this is Shumate. She works in compliance in the benefits area. And so we'll just kind of go through a quick presentation to talk about some of the upcoming changes. So we're going to move through kind of quickly, but we will have a few moments toward the end to take some questions, so be sure to write down any questions that you have. First, and probably the most important thing that you need to know, if you don't remember anything else, make sure that you remember this. This year we will have an active open enrollment. This is different from what it's been in previous years. In past years we've had what's called a passive open enrollment, which simply means if you were enrolled in medical, dental, vision, and you didn't want to change anything for the new year, there was nothing that you had to do. It would roll over to the next year. This year is different. All benefits eligible employees must sign into their benefit focus accounts and make elections for the new year in order to be enrolled. So your information will not roll over to the new year unless you take action. So you must actively enroll. Of course, we're going to get the question, well, why? What's different this year? The big difference, which we'll talk about in detail, has to do with an addition of a new high-deductible health care plan. So you'll now have another option in your medical insurance coverage. And since there are now two options as opposed to one, we want everyone to log in and elect which benefit they choose to be enrolled in, or decline if you choose to not enroll in any of them. And also, the ACA requires that we offer coverage to at least 95% of eligible employees. So it's a good record-keeping tool for us. We want you to be able to log into the system and either elect your coverage or decline it so that we can prove for federal regulation purposes that we've offered that coverage to you. What else can you do during open enrollment? You can add or change your existing insurance coverage, enroll in the FSA, Dependent Care FSA, or HSA, which we'll talk about in detail, and you can add or remove dependents. But most importantly, if you don't take action, you will not have coverage in 2019. Just a little bit about our health plan financial status. So this just shows a picture to give you an idea of the status of our health care plan. As most of you know, we are a self-funded plan. This means that we pay for any claims costs associated with our plan. So we often use the picture of a bucket to indicate how the university's funds go into that bucket, our premiums that come out of our check as an employee goes into that bucket, but also any claims filed against that plan comes out of that bucket. So this chart just represents from 2014, it is projected through 2019 to show total revenues, total paid healthcare costs, and the difference. So you will see that starting in 2015 and projected forward to 2019, we're running a pretty good deficit each year. Right now, the total deficit is totaling at about $14.5 million. So a lot of the changes that you see reflected here today in our healthcare plan are changes that we're making in an effort to try to make up some of the deficit that we have here. Some of the cost drivers that drive that deficit, catastrophic claimants. So these are major catastrophic claims that are filed on our plan each year that do have a pretty good cost. So each year we do at least have one $1 million member and 30+ individuals with over $100,000 of claims each year. Now, of course, this isn't anything that we can control. This could be you, this could be me, and just depending on what may happen in any given year, our plan does cover it. But you will see that that causes us to take a pretty good hit against our plan. Prescription drug costs. Prescription drugs are expensive. We just have a few examples here. Harvoni is $90,000 for a 12-week treatment. Humira, $4,800 to $6,400 per month. Gilenya, $7,700 per month. So these are just some examples of the types of prescription drug costs that our plans do cover, and of course it's going to contribute to that deficit. Also, in 2012, 13, 15, and 16, we did not have any premium increases. So those were years that the university chose to kick in additional money to help cover those claims costs so that we as employees didn't bear that cost. However, of course, with no premium increases, that did contribute to that deficit. And then, of course, overall inflation, 8% for medical and 10% for prescription drugs because healthcare cost is expensive. Here are the premiums for the dental and vision plans. These are fully insured plans by Blue Cross Blue Shield and United Healthcare. You see the tiers reflected there as they've always been, and you will see that we will not incur any cost increases for the upcoming year. So the dental and vision plans will stay static. Another reminder, and you will notice this as a recurring theme. Remember, this year is different. If you don't take action, you will not have any coverage. So make it incumbent upon yourselves. If you supervise anyone, if you sit next to someone in the office, make sure that you remind them when open enrollment comes that they must take action. It's different than last year. So our mantra is no action, no coverage.
All right, so now we're going to introduce you to the new medical plan option. For the first time ever, employees will have a choice in medical coverage. So right now we have a preferred provider organization, or a PPO, and we are introducing a high-deductible health plan. How many of you have heard of a high-deductible health plan? A few? Okay, good. So it's relatively simple. Basic difference, high-deductible health plan is going to have lower premiums and a higher deductible than the current PPO. You'll also notice under member cost share that right now under the PPO you're used to co-payments. So you go to the doctor, you pay $35, and that's your co-payment for your visit, and that's it. Under the high deductible health plan, it's co-insurance structure. So once you satisfy that higher deductible, then you'll pay 20% of all of the eligible charges for any services that you receive. The tax favored accounts are different. Right now with the PPO, you have a healthcare FSA and a dependent care FSA. I hope a lot of you participate in those. And under the high deductible health plan, that healthcare FSA is replaced with the health savings account, which we will tell you more about. Coverage effective date is a little different. Current employees, this really doesn't affect you, but for new hires under the PPO, you can have your coverage be effective the date of hire or the first of the following month. Under the high deductible health plan, it's always the first of the following month. So if they're hired in the middle of August, their high deductible health plan coverage is effective September 1st. Everything else is the same. Same exact administrator, same covered services, same providers. Everything is identical, and free preventive services under both plans. So if you go in for a wellness screening, it's not going to cost you anything. It's not going to impact your deductible under either plan. All right. This is our by the numbers comparison. So as you can see at the very top, premiums for the high deductible health plan are 50% of the PPO. Now I see a lot of you with your phones. I'll tell you that all this information is on our website. We'll give you the address at the end, so you don't have to take a picture of everything. This whole presentation is on the website. But yes, 50% less in premiums for the high deductible health plan, which is great. You can save a lot of money on the front end. And then the first dollar deductible. That's the next big piece. You're used to our PPO. Right now we have a $350 deductible on the PPO. $175 of that is medical, $175 of that is pharmacy. Under the high deductible health plan, it's $1,400 for a single employee or $2,800 for a family. Now that is combined, that is aggregate. So that can be $2,800 in medical, $2,800 in pharmacy, a combination of both. So it's not split like the PPO. Same goes for the out-of-pocket maximum. The PPO is split between pharmacy and medical. The high deductible health plan is combined. Now I hope you notice the out-of-pocket maximum under the high deductible health plan is a lot lower. A lot of people assume a high deductible is only good for younger, healthier employees, but that's not the case. If you are an employee that regularly utilizes our medical plan, has a lot of claims every year, and you're regularly getting close to these out-of-pocket numbers on the PPO, you can save yourself some expense by moving to the high deductible health plan. So that's definitely something to keep in mind. And just in case you don't realize, the out-of-pocket is co-pays, deductibles, co-insurance, all of that goes into your out-of-pocket bucket. Once you meet the $3,000 or the $6,000, the plan pays 100% of your claims afterwards. All right. The health savings account is paired with the high deductible health plan. It's designed to be a consumerism tool. Unlike the healthcare FSA, which we consider a spending account, you put in your $1,000, you spend it through the year, anything left at the end of the year is lost. The HSA is different. It's a savings account. So the whole purpose of this account is for you to put money aside for future medical claims year after year after year. you actually own the HSA. So the FSA is owned by the University of Alabama. Any money that you don't spend at the end of every year comes back to the university. If you leave for another job, you don't take your FSA with you. The HSA is different. It's portable. It goes with you regardless of where you're employed. And the university will never take any money back from that account. The contribution limits are higher. So the FSA is $2,650 for 2019. The HSA is $3,500 for a single employee, $7,000 for a family. So you have a lot more room to put money aside tax-free to pay for expenses. The funding is a little bit different. The healthcare FSA, all of your funds are available in January. The HSA, they accumulate per paycheck. And in the end of the year balance, this is a huge benefit for the HSA, it's indefinite carryover. So if you put $1,000 in your HSA and you don't spend a dime, you have $1,000 the next year, and it continues to roll over and accumulate. All right, so I've already talked about a few of the benefits of the HSA. It's the exact same qualified medical expenses that you're currently using your FSA for. It's going to be administered by the same company, TASC. So if you currently have an FSA card and you change to the high deductible with the HSA, that card will automatically convert. So it's really easy. There are triple tax savings under the HSA. So right now, your payroll contributions to your flex account are tax-free. And then when you spend the money out of your flex account, it's also tax-free. The HSA adds a third benefit. It gives you the opportunity to invest that money and accumulate earnings tax-free. So once you have a $2,000 minimum in that HSA account, you can invest it. That's one of the reasons we consider it a retirement savings tool. It's IRA-like investments, annuities, stocks, bonds, anything you want. Once you are 55, they actually let you contribute an additional $1,000 every year. So if you're a single employee, it's $3,500, but over 55, it's a $4,500 limit. Families the same way, it's currently $7,000. If you're over 55, it's $8,000 a year. So that's a big advantage for those of you who are close to retirement and looking for other ways to put money aside. And once you reach 65, this is really important. We have a lot of employees that work past the age of 65. If you enroll in Medicare, even while you're still working here, you're no longer going to be eligible to contribute to your HSA. But any money that's in that account already, you can use it. You can pay your Medicare premiums, long-term care premiums. You can withdraw it and spend it on other necessary things. So it's a pretty good option for retirees. So we've mentioned the tax-free payroll deductions. Another big bonus to the HSA, you can change your monthly contributions. So with the flexible spending account, you elect a static number in open enrollment, and that's all you can contribute for the following year. With the HSA, you change it however many times you want, at least once a month if you wanted to. So if you have an unknown, unseen medical expense in January and you realize I need a lot more money set aside, you can bump that contribution up in Benefit Focus, and it'll add more to your account. These are, again, the contribution limits. And I do want to point out, regardless of the family contract tier, the IRS considers every family contract to be the same, so it's all $7,000. Now, we do realize that the higher deductible is a little scary. It can seem like a big obstacle if something happens to you in the beginning of the year before you've accumulated all this money in your account. So the university is going to contribute seed money to every HSA. So if you're a single employee, the university is going to give you $400 at the beginning of the year. If you're a family contract, it's $800. So you will have that money in your account in January. All right. And then last slide about HSAs. I know it's a little boring, but it's really important. So the health savings account, in order to contribute to one of these accounts, these are the rules you have to follow. First, you have to be covered by the university's High-Deductible Health Plan. You won't even have an HSA as an option if you stay with the PPO. Second, you cannot also be covered by a non-high-deductible health plan. So if you have a spouse that works somewhere else and they have PPO coverage, you cannot also be covered under their family contract. You need to be standing on your own with the high-deductible health plan. You cannot be listed as a dependent on someone else's tax return. You cannot use your HSA to pay for ineligible dependents. Now this actually applies to the flexible spending account and the health savings account. So if you have a dependent who is 22 years old, out working, they're no longer considered a tax dependent by the IRS. The ACA will let them stay on your health plan until they're 26, so that's great. But you're technically not supposed to use your flexible spending money or your health savings account to pay for their medical claims. So that's an important distinction. If you do have a child that falls into that category, they can open their own HSA, and you can contribute to that account, and they can spend their own money for their co-pays, or co-insurance in this case. And then finally, you cannot also be enrolled in a flexible spending account, and that also applies to your spouse. So the IRS does not want you to have access to another tax-favored account to cover that high deductible. It's either HSA or nothing. And this is another reminder. So the enrollment process, open enrollment, is changing this year. We want you to follow very closely what we're recommending, that you log into Benefit Focus during these 2 weeks. You have 2 weeks, 24/7, the whole time, to actually select your coverage, re-add your dependents. So we want you to have coverage come January. If you don't take those steps, you will lose your coverage, and we're not making any exceptions. That could jeopardize the university's tax exemption status. So please remember, and please remind your coworkers.
Okay, so here are a few of the changes to our current PPO plan. So this is the plan that you're already used to. We have a few plan design changes. First, emergency room and specialist copays. The emergency room copay will increase from $125 to $150. So if you do receive services in the emergency room, you'll be billed for that $150 copay. Also, a specialist visit is increasing from $40 to $50. So if you see a specialist, that's a cardiologist, podiatrist, dermatologist, you'll be paying a $50 copay for those doctor's office visits. There will be a 20 visit per year, per person per calendar year limit on physical therapy. So this is changing to be consistent with the visits that we have for speech and occupational therapy. Currently, physical therapy is unlimited, but starting January 1st, 2019, it will be limited to 20 visits. And also out-of-network services in Alabama. There will be an increase in the co-insurance from 40 to 50% if you use an out-of-network provider in the state of Alabama. This is going to have minimal impact in Alabama. Blue Cross Blue Shield has a very large network, and the vast majority of providers in the state is considered in-network. But if you do receive services from an out-of-network provider, you will be paying more out-of-pocket for that cost, and it does have zero impact out-of-state. Another big change is the PPO first dollar deductible. Under our current plan, that $350 deductible applies to a maximum of 3 per family. So if you have yourself, a spouse, and 2 children covered under your plan currently, you only have the potential of meeting that deductible for a maximum of 3 per family. Well, beginning in 2019, that deductible is going to apply to each individual member covered under your plan. So for example, if it's just you, you'll pay a $350 deductible. If it's you and 1 other dependent, be a spouse or 1 dependent child, it's $350 for each of you. But here, if you have a family of 4, you have that deductible for each member covered under the plan. So in the example given here, it's up to $1,400. Flexible spending accounts, we've already talked a little bit about these. The healthcare FSA, dependent care FSA. Healthcare FSA has an annual contribution limit of $2,650. Dependent care, annual contribution limit of $5,000 with a minimum contribution of $125 for each. Those healthcare FSA funds are used to pay for out-of-pocket healthcare expenses for you and your tax-eligible dependents for any services received for medical, dental, and vision not covered by your insurance. The money that's set aside in a dependent care account is for the purpose of child care expenses for children under the age of 13. As most of you are aware who participate in the FSA, you make your elections for the entire plan year, and that money is available to you up front, and we just divide those deductions over your paycheck for the rest of the year. But with the dependent care account, it is funded per paycheck. So you're only eligible to be reimbursed what we have actually deducted out of your paycheck at that time. You can still use the debit card option or file a manual reimbursement by submitting a receipt to the vendor to task. But both of these accounts are a use it or lose it program. This means you do not want to grossly overestimate the amount that you contribute to this account, because you have to incur those charges by December 31st of the current plan year, or anything left in that account is forfeited to administrative cost. You will have until March 31st of the following year to file for reimbursement, as long as you incurred that charge before December 31st. Another new program that we're adding this year is called our Premium Assistance Program. And this is a program where UA will provide a premium discount to benefits eligible active employees based on their family size and their total combined household income, and where that falls in relation to the federal poverty level. So you do see a chart here that indicates total family size and annual household income. If an employee applies for this benefit and their annual household income falls below 1.5 or 1.5 times the federal poverty level, they will be eligible for a discount on their insurance premiums. To apply, there will be an application on the benefits website. They will complete that application and provide documentation which includes federal income tax returns, W-2s, and 1099s. They must apply during the open enrollment period between November 1st and 15th. And based on how they qualify, they will be eligible for a $54 discount off of their premium, regardless of what tier they fall into. That $54 premium is equal to a single high-deductible health plan premium. So if a person is enrolled in a single high-deductible health care plan, that premium is $54 per month. So hypothetically, if they're a family household of one and their annual household income falls below $18,210, then they have the potential of having that premium discounted to be free, because it's a $54 premium and a $54 discount. Current employees will submit that documentation during open enrollment, and newly eligible employees can submit it within 30 days of their effective date of enrollment in the healthcare plan.
And I want to point out one of the reasons we're doing premium assistance. Right now, our medical premiums, we have 2 tiers. So we have a salary under $26,000 tier and a salary over $26,000 tier. We're eliminating the salary tiers and replacing it with this premium assistance option.
Okay, so PPO plan premiums. So this is a comparison of the premiums from the current year to the 2019 year. You will see the prices reflected here based on if you're paid monthly or biweekly. Something that you will notice on this chart is currently we do have 3 tiers of coverage: employee only, employee plus one, which is the employee and one dependent. That can be a spouse or one dependent child, or family, the employee and 2 or more dependents. For the upcoming year, we will still have 3 tiers of coverage, but those tiers have changed. The rate that you will pay will all be dependent on whether or not a spouse is covered under your plan. So we have employee only coverage, family without a spouse, family with a spouse. So what's driving these premiums is whether or not a spouse is covered under your plan. Quite simply, spouses are usually older, they have higher claims costs, and so they cost the plan more money. So based on whether or not your spouse is covered is going to determine what you pay. Something you will want to pay attention to: for those of you who may currently have an employee plus one coverage, for you and a spouse, you're currently paying $340. But under the new plan, you would be covered under a family with a spouse rate, which is $447. That is a pretty significant increase. It is. Of course, we're very well aware of that. That's part of the reason why we want to make sure that we get in front of you as soon as possible, have this information available to you, because for those of you who may have a spouse who works at another employer who may be eligible for coverage, prior to our open enrollment and their open enrollment, it's the perfect time to sit down and consider what's going to be the best option for you and your family. Whether they should be covered at their employer and you covered here, whether you all should be covered at one employer or the other, every situation is going to be different. So the best thing that you can do is be informed and compare with any other coverage that you may be eligible for to determine what's best for you and your family.
And if you do decide to drop your spouse during open enrollment, then that will trigger a qualifying life event at their employer, so they can pick up their employer's coverage at that point, come January 1st, when their coverage with UA would end. So that's always an option, regardless of when their open enrollment period falls.
And really the bottom line with this, I mentioned earlier, we have a $14.5 million deficit. With these premium changes, we expect that premium revenue increase to be about a little bit less than $7 million. So you'll see that even with these increases, we're still only meeting about half of that deficit. Pharmacy benefit changes. So UA will return to Prime Therapeutics as our pharmacy benefit management company. This is intended to provide some improved customer service by simplifying some of these processes. So effective January 1, you will have one ID card for both medical and pharmacy benefits, one source for all mail communication, 24/7, 365 access to member services, and single sign-on at My Blue Cross where you can view your medical and pharmacy claims all in one place. So since we'll be returning to Prime Therapeutics, all covered members will receive new ID cards before January 1st. So that one ID card is the one that you'll provide to your physician as well as to the pharmacy. And so once you receive those cards, you can discard any old Blue Cross Blue Shield or Optum Rx cards after January 1st.
And your mailing address where the cards are being sent, that's your MyBama address. So please log in and check that before January 1st to make sure your card is sent to the correct location.
Okay, some key takeaways. Again, active and open enrollment from November 1st through November 15th. No action, no coverage. So again, make it incumbent upon yourself to make sure that you remember, but that you also remember to remind someone that you have to do something this year. You'll have a choice between the PPO and the HDHP with an HSA. We will be providing some more detailed sessions specifically regarding the HDHP and HSA. So if you do think that is something that you're interested in, please join us for one of these sessions that we'll have in October, the 4th, 9th, and 25th. We'll be providing some more detailed information about that new plan. You will notice that the one that's on the 4th is held between 5:30 and 7:30. That's intended to be after the normal work hours. That way, if you'd like to have a spouse accompany you or someone who you feel may need to review this information, that is available. You can also visit our open enrollment website, hr.ua.edu/benefits/open enrollment. There you will find our newsletter, a copy of this slideshow, and some pretty detailed FAQs that could probably answer a good number of questions that you have. We also are activating some social media accounts on Twitter at Bama Benefits, Instagram at Bama Benefits. There we will just be sharing some FAQs, some reminders, and some information that you'll need to know throughout the time leading up to open enrollment and, of course, during the open enrollment period.
Questions? Yes, ma'am.
Any possibility that y'all would create a worksheet to help us figure out our savings?
Under the new plan option?
Yeah, like just what I've been doing, what my expenses are, my
Yes.
stuff.
Yes, ma'am.
That would be really
So we are in the process of producing a how-to guide that will lead you step by step through logging into Blue Cross and logging into Optum, so you can pull your current claims for 2018. And then there's a little worksheet that will help you compare if you had had a high-deductible health plan this year, what you would have spent.
Right. Is that's a go?
It's not posted yet, but it will be posted to this website. So I would check back next week, and it should be available. Yes?
Currently, faculty staff plan offers a discount, I believe, on your copay. Will that still be in place?
So the high-deductible health plan does not have copays, so it's a co-insurance system. So unfortunately, that discount and copay will go away at the faculty staff clinic if you're on the high deductible. It'll stay in place for the PPO. It's still a cheaper visit, so, yes, sir.
Hiram, as you were discussing the numbers, you said we're about $14 million in the red in terms of the plan as far as where it is. But almost half of that is coming from projected year 2019, which also is showing almost $7 million in difference between the revenue and the cost. What is driving that change that's causing 2019 to be so different from the previous years? Slide number 4 is the one that had the numbers.
I will let Jay answer that.
I'm gonna kick that to the money guy. He does the numbers on that
He was
part.
our projection.
Yeah, so, I mean, if you want to get to how we actually calculate that, I'll be glad to sit down and talk with you. But what it does is we take 24 months of claims, 2 years of claims, and we actually weight the most recent 12 months a little heavier, and then we trend that forward. So it's actually using the most recent experience to actually project that forward, and that is why it's saying that we need 7 million, because it's looking at our most recent experience, which is actually heavier than previous.
Right,
years.
so I will admit, this chart has not been updated since we created the presentation back in about April. Our current 2018 losses are more around 3 million, almost 4 for the year so far.
That's a good point. This data's through January, so it's not showing. We like, just for example, last month we lost 1.3. We had a shortfall of 1.3 million just in last month.
Right. And we are not trying to make up $14 million in a year. That would be impossible. This is just explaining why we do have the increases every year and why we are constantly tweaking the benefits to try and save costs anywhere we can. Yes, ma'am.
On one of your slides, you showed the years that there was not an increase, but in this one, there are definitely deficits. Why didn't someone project back in 2015 that we were going to be 14 million in the hole?
Well, we did in fact project that we might have losses in those years, but the administration made the decision to add additional funds. You'll notice in the first bullet, UA added 2 million in 16 and 1.2 million in 17, but they chose to add additional money from the university instead of putting that on the backs of the employees. What maybe, looking back, we could have used that extra funding, but we did not get it, so now we are where we are.
The Faculty Staff Benefits Committee every year has recommended an increase
Yes.
on the premiums. Administration felt in those times to not do it because the raises were negligible.
Right.
I mean, it's a good and bad. You know, you pay me now, you pay me later, unfortunately. And this is not just something that we're facing. This is nationwide. Other companies are facing the same thing. Prescription drugs, specialty drugs, they are really, really driving up the cost. Thank goodness we have the coverage that we have today, and it's available to us. And these are miracle drugs that are taking place here, but they come at a cost. And thank goodness they're there if I need one. But again, it comes at a cost. So.
Yes, ma'am.
If we opt into a high deductible plan, this, in 2019, will we, if we just change our minds, can we go back to the PPO?
You can go back and forth during open enrollment whenever you would like, but it's only during open enrollment.
And so what happens if that money in the savings plan, in the savings account?
You keep it, and then you could use that money to pay for your PPO copays and your PPO deductible.
Oh,
So you never lose that money. Regardless of the type of plan you're covered on, once you have funds built into an HSA, you can spend that money until it's gone. Yes, ma'am.
So is, like, the year that everybody had to reaffirm who your spouse was, who your children were, did that attribute to this main deficit that people were covered under, that should have been covered?
No, I think there were very minimal numbers.
But I'm glad you mentioned that, just as a sidebar, not directly related to your question, but because you will have to re-enroll during open enrollment, you will not have to add additional documentation for your dependents. If your dependents have already been verified, they will be verified going into the new year. So you would only have to add documentation if you're adding a new dependent to your plan.
I have one more question.
Sure.
So, like the $26,000 thing went away for the people under 18, but like, for instance, people that make like over $125,000,
Right.
theirs is the same as mine, that I only make 30, whatever?
It is, you would be surprised, salary tiers are actually not very widely used. When you compare us to STC institutions, it's usually based on spousal coverage or number of dependents. salary tiers is just not that common. And it's also harder, the 26,000, we had not adjusted that for inflation and who knows how long. So it's much easier to have the premium tier set up this way. Yes?
How will the healthcare changes affect spouses that work? Will they have to enroll an employee with spouse, or can they have two individual plans?
Oh, you are welcome to have 2 individual plans. We would advise you to have 2 individual plans if that's an option. But if both spouses work here and you have children, then you will be put into that higher salary, into that higher premium tier, family with a spouse.
To clarify all of that, if you and your spouse have different plans, that's okay as long as you're not using the HSA on the other person.
So actually, if both of your spouses, if you both work here, then you could each have an individual HSA, but you would still be eligible for the family contribution limit, and you could split that however you want. One thing I didn't point out, in all the HSA rules that I covered, the university's not going to monitor that. It's not our account, so that's all between you and the IRS. If you decide to take your HSA money and buy a boat, and you get audited, the IRS is going to hit you with a giant excise penalty. The university's not going to know what you did with that money, so that's another example. I mean, if you over-contribute, if you have way too many HSAs and spend it on the wrong people, something for you to keep track of. Yes?
With 2 spouses, one elects for the high deductible and one does PPO. Because you said something about when spouses, you can't have FSA and HSA.
Yes. So in that scenario, if your spouse wants PPO and you have the high deductible health plan, then you would just have to choose between the tax favored accounts. I would obviously recommend that you choose the HSA because you have that added tax-free benefit of investments and the money carries over and you can contribute more. But yes, they would need to have the PPO without an FSA, and you would not need to be covered under their PPO. Yes, ma'am?
So are we going to have increases each year to make up this deficit?
I would expect that increases will continue. The Faculty Staff Benefits Subcommittee does recommend that we have at least minimal increases every year, so I don't see that stopping.
Well, along those lines, then, as the deficit changes, goes up or down, will the premiums go up or down across the board or differently for the PPO plan versus the high deductible plan based on which one had the most impact on the change?
We don't know. I don't have an answer to that right now because we don't have a high deductible health plan in place. It'll all depend on how our claims look, what our experience looks like after 2019. So there's no telling. I would assume they're going to be equally weighted changes, but I cannot guarantee that. And I will tell you this, premiums will not decrease. That is a very, very unlikely scenario. Yes, ma'am.
The $400 seed money that UA puts into the HSA, does that have to be repaid at any point?
It does not. That is the university's gift to you. You could get the seed money on January 3rd and leave the university forever on January 5th and take the money with you.
We'll be a little mad, but.
Yes, so I do want to clarify, the seed money is a lump sum in January. Your HSA contributions that you elect, those are accumulated per paycheck. So that seed money is to offset that sticker shock of the deductible if you have a claim in January. Yes, sir.
So we have a professional staff on Twitter asking, do you plan to offer the seed money every year, or is it just the intro year?
So it is guaranteed for 2019. Future years, it's up to our budget decision makers, whether we can continue to offer it. Yes, sir.
You talked about changing the different company we're using for prescriptions, but not really about the changes in the cost for prescription.
Right.
Can you walk through what that looks like for PPO versus the high deductible for prescription costs?
Sure. So the formulary is obviously going to change. We are going from Optum Rx's formulary to Blue Cross and Blue Shield. Under the high deductible, you're not going to have co-pays. So it's going to be very important for you to consider the cost of the medication you're taking. If you're currently taking a brand medication that's $500, but there's a identical generic out there, you may want to consider taking the generic under the high-deductible health plan, because you're going to be paying that 20% after your deductible's met. So 20% of 500 is a lot different than 20% of 10. But it's all going to depend on your individual medications and asking your doctor and your pharmacist what those costs look like.
If I were you, also, if I'm on the high deductible, and I have a script, I'm gonna call around. I'm gonna call multiple pharmacies, because
Right.
they're not all the same
You can
price.
actually use GoodRx. I don't know if anyone's consulted that website, but GoodRx, you can plug in a medication and it will tell you the average cost at most of your local pharmacies to give you a better idea of where it might be more affordable.
How soon will you have an approved pharmacy list?
So, actually that list, if we can tell you the formulary that we're using for Blue Cross and Blue Shield, it's the net results formulary. It's on the Blue Cross website right now. You can go and look at it whenever you want to.
It's not to say it will be the one that will be in effect when we.
Right, it likely will be different because they make at least twice a year. I actually think Blue Cross does it quarterly. They tweak their formulary a little bit, so whatever it looks like now, it's not going to be exactly the same come January 1st.
It's the 4-tier network, not the 6.
Yes.
Net results one.
Net results with 4 tiers, because that's generic, preferred brand, non-preferred brand, and specialty.
For the premium assistance plan, do folks have to produce those tax documents during that same 14-day period?
Yes.
Okay, is there extra communication, or are there ways that we can help get that to the folks who might be in those brackets, if that range, because if they miss it, that can be pretty.
Right.
It will be communicated on the website, in the newsletters. We will include that information on our social media accounts and as a part of the emails that we send out. So it's not intended to be hidden by any means. We want people who are eligible for it to definitely take advantage of it. But again, that could be one of those things that you make sure that you mention as you're talking about it amongst yourselves. If you, just mention it. Everybody's not going to be eligible, but we never know what anyone's total household income is. So we can only make projections based on what their pay is at the university, but it doesn't determine what their total household income is. But we will try to make that information readily available so that people can take advantage of it if they're qualified.
Yes, sir.
Yes, in one of your slides, you showed that the contributions to the HSA stopped, or you were ineligible to do it after you reached the age of 65 and enrolled in Medicare.
Right.
Do you have, is the university requiring those over 65 to enroll in Medicare?
No.
Okay, thank you.
Right, so if you do not enroll in Medicare and you're 67 years old, you can continue to contribute.
Thank you.
I have a question about that. If you're 65, you have to enroll in Medicare Part A, but you don't have to pay.
Enrollment in Medicare Part A is also optional if you're still actively working. You're only required to enroll if you're no longer covered under an active employer plan. So you can waive your enrollment in Medicare at age 65, and then once you get ready to retire, activate it effective with your retirement date, and we will just have to provide proof that you were covered under our plan so that they waive any penalties that would be applied. But you can decline participation at 65 if still covered under an active employer plan, whether that's your employer or even as a dependent on a spouse's active plan.
Yes, ma'am.
Back to the prescription question. Will Blue Cross Blue Shield be providing a list of places they do business with? Because I know that over the last couple of years, they have stopped doing business with Walgreens and CVS.
So Blue Cross and Blue Shield, Prime Therapeutics specifically, those pharmacies are still within their network. I think that was for certain employers, or maybe they're fully insured book of business, but we're self-insured plans, so we have access to those.
Okay.
And under the My Blue Cross website, they have a really great provider search tool. You can look up physicians, pharmacies, durable medical equipment, vendors, anything you want within a certain geographic radius. So I would suggest looking there if you're wondering if a specific pharmacy is going to be covered. But don't worry, CVS and Walgreens will be covered. Yes, ma'am.
Will there be any fees associated with an HSA?
No. There are no fees. We actually pay an administrative fee for you. Yes, sir.
This presentation will be online.
It is on the website right now.
Which website?
It's our open enrollment website, which we showed you at the end. Get all the way down there. So this is our open enrollment website. All of this information in the presentation is on the website, including additional detail, the FAQs that Hiron mentioned. Lots and lots of material is out there. And everything that we send to communicate, newsletter, postcard, mailed poster, all of that's going to be available on the website as well.
Would it be helpful to click on so they can see
Sure.
the bullets and everything?
So, is there another question? Yes, ma'am.
Is the HSA at a particular bank, or can we choose a bank?
So, Task uses Healthcare Bank, and that is one of the top HSA banks in the country. Multiple vendors use that exact same bank. You do not have a choice if you enroll with our HSA through Task. Now, you could potentially elect an HSA somewhere else from another company if you didn't want to use ours for some reason, but then you would not have access to the seed money.
Explain the card, about the FSA, HSA, the card. Tax.
So you do have the debit card for either your healthcare FSA or your health savings account. Now, you want like the substantiation piece?
Just about, you can use the same card.
You can use the same card. It will convert automatically if you switch from the FSA to the HSA. I guess I should point out, since I mentioned it, with the healthcare FSA, you've probably gotten a request every now and then for substantiation. So if you have like an orthodontia claim, they might ask you to verify that you actually spent your money out on that orthodontia. There's no substantiation under the health savings account. That's another reason we emphasize it's between you and the IRS. They are assuming that you are using it correctly, and if they find out you're not, there's a big excise penalty that they will charge you, and you don't want that. Yes?
The interest on the money in the HSA, does that go to the insured, to the university, or does the bank keep that?
The HSA interest?
Yes.
Oh, that's yours.
Okay, so
Yes.
that compounds on our,
Compounds in your account, so you win, lose, however you invest it. We have no control over the actual investment options that are offered. That's all through Task. So yeah, totally your money, your interest that you would accumulate. Yeah, this is our open enrollment website, and right here, these are all of the main topics that we have discussed today. You can click on all of these, and I'll point out under the High-Deductible Health Plan and the Health Savings Account pages, all the information, and then the frequently asked questions we mentioned. Huge, giant, 8-page document, every question you could have about a high deductible or an HSA. Yes?
Is there a reason we choose to give the grace period for the FSA as opposed to a refund? Since the IRS offers the multiple options for what to do with that carryover balance.
I'm not sure the question. Say it again.
For the flexible spending account, there's two different options you can do for the leftover balance.
Right.
Carry it over there. Look, people,
Just curious why we choose
the
to do it.
complexity of trying to figure out how much you need in a 12-month period is hard enough. When you add in another aspect of, okay, I'm gonna carry it over for 3 or 6 more months, and then it rolls over, and then I have to look back, we opted not to do that. And it actually works better, because once we roll out, go ahead.
Yeah, so it worked in our favor to not have the carryover.
In our favor, who?
In the
The
university,
university
in the employee's favor.
Yes.
So now that we're adding the HSA, if we offered a carryover option and you carried $500 over from your flexible spending account into 2019, you could not have an HSA in 2019. So that saves our employees a lot of stress
But in the past.
trying to spend that money down. It worked out. Any other questions?
Well, we want to thank you for your time. Thank you for listening and asking great questions. And we look forward to hearing any other questions that you have. Thank you all.